Hello, everyone, and a very warm welcome to today's major markets update for Friday, the 15th. And we are dealing with fractals. Simple corrections can always become more complex. That is the fractal nature of the market. A simple ABC can turn into a double ABC. We cannot know that beforehand, and we just experienced one. Don't tell me that the Elliott wave doesn't work. We simply cannot know by September 7th that we will get a double zigzag into September 15th. That is nigh impossible to know. Could be a flat, could be a triangle. All we can go by are the breakout levels. Then we also present alternatives in case we see follow through to, for example, in this case, the upside that will give us insurance policies on what is going to happen if we see such a breakout. Because remember, while everyone always wants to know exactly what's going to happen next, there are simply times which is less clear, especially corrective price action. All right, that cannot be accurately forecast. So the bottom line is that we got a dreaded complex correction. Now let me go straight to point number 6. Over the last several weeks, or at least 1 week, we preferred a gray wave 2 to ideally 4,500 plus or minus 20. We narrowed it down to 49.90 plus or minus 10. Ultimately, the S&P 500 topped, this is for the S&P 500, at 45.12. That is a pretty darn accurate forecast. Now, how we're going to get there again, that is impossible to forecast other than an ABC. But an ABC can become a ABC, ABC, etc. Nothing we can do about. That's just the way the market works. So we had our prognostication is that once we complete that, we'll get wave 3, 4, and 5 to these target zones. Nothing has changed, okay? Nothing has changed. All we do is provide you then with an alternative Elliott wave count. We always said the index must break above the September high, which I believe was 45.41, somewhere around there, to tell us that we are in a bullish phase, and then we get the contingency plan, the alternative, a ending diagonal wave 5, which are very ugly. It's all 3 waves. All right. And so far, we've seen 3 waves up, 3 waves down, 3 waves up, etc. Even all the way back from the August 18 low and from the July, I think, to 26, 27 high. 3 waves down, 3 waves up. That could be eventually all become part of a ending diagonal. Then the August 18 low was wave 4, 3 waves back up, etc. But we did see a 5-wave impulse, especially on the NASDAQ 100 down from September 1 into September 7, which was our initial indication that we would see a C wave of a more complex 4th wave. All right, so we're dealing with a lot of waves on many different levels: short term, intermediate term, longer term. All right, again, we cannot know that a wave 2 becomes more complex than initially anticipated ABC. All right, so that's why we always go by price levels. And when we then see price go a little bit higher than we think it should stall at, we start to provide an alternative Elliott wave count, which is our contingency plan. Right? It is our insurance policy. In case we are wrong, in case we get an accident, then we know that we need to get out. This does not mean that I'm covering my ass and just to say, oh, look, I'm right anyway. If you think that's the case, you really don't get it. Yeah. But I know a lot of you get it, but just for those people that are going to listen to this later on for free, if you think that's the case, you really don't get it. So that brings me, after this rant, back to line item number 1. The S&P 500, NASDAQ 100 top exactly at their 76.40% retraces. For the NASDAQ 100, I said if we get a breakout right above the previous high, we would target 15,600. I think we got 15,512. So I was off by 88 points, which is 0.5%. Part of my inaccuracy. I cannot get it more accurate than that because we're dealing at some point with a CSA extension or a CS 1.236, 1832. We don't know. So we need to set a range. S&P 500 was supposed to target 49.90 plus minus 10, narrowed down. which is within the 4,500 plus minus 20. We got 45.12, which is, I believe, 7 points away from a 76.4% retrace of the September 1 to September 7 decline. Picture perfect. It doesn't get more accurate than that. Now, the current decline we saw today, which broke below those key levels that I outlined yesterday, is most likely a wave 1 of wave 3. I'm expecting a bounce back to about 4480 plus minus 10, and the NASDAQ 100 15,380 plus minus 50 for a wave 2, and then we'll get eventually 3 of CO4, etc. I'll show you those in a minute. We must rally above yesterday's high to invalidate our preferred bearish pattern. Our preferred bearish pattern remains unchanged until we see a breakout. Please remember, the futures market got as high as 4516.4, which is really, they were really pushing it last night, but they failed completely. So, bigger picture wise, you know, this one, either we're in a B wave or we are going to subdivide higher with a potential for a B wave one more time at around 4,800. All right, we'll keep tracking everything. This is the bullish scenario, going to 5,034.24. And the bearish scenario is we have already topped, or we're going to top a little bit closer to 4,800. I prefer the latter scenario. In that case, then we do the whole scenario of a larger B wave top again. And if we then eventually only bottom at 4,400, break out again, you know, this bull market is going to extend one more time. That's it. We'll deal with that later. Stop losses, key levels to watch. For stop losses, of course, are those breakout levels in case you're long or short, depending on your aggressiveness. So if I say first warning is level X, second warning is level Y, third warning is level C, you could use those, for example, as stop losses or as a trigger to go long or short. All right, that's instrumental for one's trading. And sometimes the futures market will gap above or below those levels. That can happen. That we can't control. This is the primary perspective of any wave, 5 up, 3 down. This is always the longer term bull market. There's no reason for a market to long-term decline. Then it's useless. So here are many ways for you to get help with your trading if you so desire. There will be a 7th version coming soon, and please stay tuned for that one. It's been underway, fully automated trading. Anyway, moving on. Here we have the 5-minute chart of the S&P 500. Looks like a nice impulse lower. You know, again, this is 5-minute chart, so it's a little bit open to interpretation. If you try to interpret every little 5-minute scribble as a wave, you'll certainly miscount a few. But it still looks good like an impulse. I'm okay with this. So we should be bottoming out most likely soon. We bounce back, and then 3, 4, and 5. As you can see, the 5 of the 3 starts to now overlap quite nicely with the 3 target zone, 4 and 5. This is still the preferred path. Again, remember, CSA would target 45.15. Yesterday, we got 45.12. We're off by 3 points. It doesn't get more accurate than that. And remember that the predominant view, or the primary view, was that we were dealing with a counter trend rally. So if you would long a counter trend rally, please make sure you have small position sizes, for example, tighter stops, for example, lock in those profits, be very fast from a shorter term trading perspective. I can't get it more accurate than that. 45.15 versus 45.12 in the cash market. Futures market, 45.16.4. This is, you can't get it more accurate. Barely a computer will get it more accurate. So please make sure that when you counter trend trade, when the primary expectation is for counter trend rally, to trade it accordingly. All right. So here we then have this ABC, very complex correction. The market could have decided all of this wave 2, which is our primary view still. It's not been proven just yet. Could have completed, okay? But it decided not to. For whatever reason, it decided that was not the case. So it made it WXY or simple ABC as well. It's a double zigzag. You know, potato, potato. I prefer ABCs. It's already complex enough. If we add 3 more letters, it just gets even more complex. Let's not do that. So here we then have a slighter bearish option. that today's bounce was already this wave 2, barely a 23.6% retrace. But in a bear market, in this case, the C wave of the fourth wave, upside disappoints, and it's technically possible. If we break below 44.30, then wave 3 is already underway. Okay, so this is very possible. And then these levels will have to move a little bit lower. It's fine. We will get, I believe, somewhere like this. All right, these ones will target pretty much based on standard Fibonacci-based impulse patterns. Okay, I cannot foresee extensions. We cannot predict the future. Remember, we're dealing with a complex system, which is made of complicated parts. By knowing all the complicated parts, you can still not forecast the complex system because there's so many nonlinear variables. So I don't know if it's going to do 161.8 or 261.8 or 138.2. That we don't know. So that's why I present you target zones. That's all we can go by. So we'll know soon enough. I prefer a little bit of a bounce first for a more proper 1-2 setup. That would be really nice. 1-2 and then 3, 4, and 5. And if that's going to happen during the Federal Reserve announcement next week, I don't know. Couldn't care less. You'll notice most of the time I won't mention any of those news events. This week, the market actually rallied on worse than expected inflation data. It was definitely not as great. We can parse it down and say, well, this was better than that one, but in general, it wasn't as great, but it still rallied. So I'm not going to forecast the market based on the news event. Here then is the daily S&P 500 chart. And I wanted to show you that we haven't moved this wave 2 label here, right there. So we can do it now. And as you can see, we top right there. Okay, this is as accurate can be. We place the wave 2 here. We break below 44.30. I'm going to look for 3, 4, and 5 to about 42.70. Please remember that 42.70 is a 76.4% retrace, extension, of this wave 1 measured from wave 2. It matches very well with a CSA relationship and reasonably well with 3, 4, and 5 pattern. I would have liked the market to stall out at 4,500 instead of 45.12, but we still can kind of get there. With just 12 points more, it means that the wave 5 here is then off by 24 points at its lowest, so that we target somewhere around 42.90. That's still pretty reasonable, okay, and we can always get a slight extension. But so far, so good. This still points towards the same target region. So we have many levels of confluence, right? So we have a CSA at 42.70. We have a 76.4% extension at 42.71. And then we have about a 5 is 2 times 1 extension at about 42.85-ish now. But if we had topped here at 4,500 instead of 45.12, it would have targeted 42.74-ish. So as you can see, there is plenty of confluence at that level. And that often means that we'll have a good target for the market to reach. All right. Then, of course, we still have alternative scenarios to deal with, which we still cannot take off the table. Okay. This is the ABC of this ending diagonal. I still cannot take the ABC of the ending diagonal off the table. So far, as you can see, we bottomed right here in this B wave target zone. So please be aware this potential is still on the table. It's not my preferred, because so far it looks like an impulse lower, and we've been doing what we were supposed to do, right? Bounce to 4,500 plus or minus 20, and then start to decline. The bounce did become more complex, but remember, in ending diagonals, it's essentially all threes. So then we have a 3-wave A, all right, just as we had a 3-wave 1, a 3-wave B, so for A, B, C, and then we get C to complete green 3. It's still possible, right? It's not a slam dunk just yet. Just wanted to make sure that we have this insurance policy still on the table. So when we break above 45.15-ish, yes, then we start to look for 46, 4,700. And if you're still short then, for example, then you know that is the GTFO type of level. Like, yeah, I want to take my losses. Trading is about one thing only, minimizing losses. All right. Second rule, minimize your losses. Third rule, make a profit. That's pretty much where it is at. Then a kind of similar alternative is that we are also still in ending diagonal, but we get an ABC lower for this wave 2, and then we rally. Okay, we still need, of course, to break ultimately below the August low to fully confirm the 1, 2, 3, 4, 5. But so far, stick with it. So please keep this in mind. There is still some bullish potential left in the markets, though it's not our preferred scenario. Okay, this would then be a 5, 3, 5 type of decline. And again, we get back above 45.15, even 45.12, then I'm going to be in this camp. Okay, so if we bottom out here about 4,400 for this wave 2, and then we break back above 45.15, I'm going to be in this camp, all right, which will be rather similar to this setup. That's our alternative scenario. And I'm not the only one who is telling you that it is complicated, especially this rally since September 17, or that we are potentially still in a bullish scenario. This is work from our friends at wavtradernet. This was posted today. This is from 3 days ago, where Avi also recognizes the potential of this ending diagonal. Okay, so we're not the only ones, but I think we got it a little bit before he did. I don't know. I don't subscribe to his stuff. It doesn't matter. It's that great minds think alike, and he's recognizing the same pattern. All right. Another thing I wanted to point out is what is a reliable trade. In this case, is waiting for a short below 44.30, okay, or below 44.05, that type of stuff, right? It's better to have a reliable trade than an unreliable trade. And trying to nail tops and bottoms is the most unreliable. It's the most profitable, but also the most unreliable, right? With the yin comes the yang. It's most reliable, least profitable. And it all depends on what you're after. I'm after profits. I don't care if it's 10 times $100 is better than 1 time 1,000, all right? Especially since trading these days is essentially for free. There's no commissions anymore. Even put options like 50 cents. It's ridiculously cheap. So we're still recognizing this potential. He also points out if we break over this week's high and follow over 45.15, so this was posted on the 12th, that opens the door to 4,800. Okay. Again, it's not his favorite, but it's something we recognize. We have to recognize this. That's our insurance policy. We got to 45.12 and we broke down. So still possible? Yeah, still possible. Less likely. And then our good friend Pretzel also figures out that the S&P 500 appears to have added on a second ABC to create this WXY correction, all right? Again, he forecast 45.10.20 a week ago, so did we. This is from 9/11, so yes, that's a WXY, and it still looks to be the case. Otherwise, it's a 1-2 kind of setup over the ABC, as I showed you for the ending diagonal, however exactly it wants to fill itself in. But for now, the WXY is the most likely scenario, looks very corrective. And please remember that we still are dealing with, in this case, 5 waves lower on the NASDAQ 100. It's one of the cleanest and clearest impulses I've seen so far. And that this, all of it looks sloppy. Excuse me. The September 11, 12 decline did look like an impulse. Unfortunately, it wasn't. It morphed into a double zigzag. Right? You could count it as 1, 2, 3, 4, 5, for example. It wasn't. So we're dealing here with a double zigzag. And also here, we kind of have a double zigzag on the way up. So we had a double zigzag on the way down and a double zigzag on the way up. ABC, ABC, all right, WXY. And now, as you can see, the NASDAQ topped at 15,520 or something, whatever it was, very close to the 76.4% retrace, which is a typical second wave target. So anywhere between 50 to 76.4%. All right. It can be 38.2. It can also be 23.6. Doesn't have to go. As long as it retraces something, but most likely you get a retrace like this, wrong foot everybody. And once again, this decline here looks rather impulsive. So I expect an A, a B, and a C up Monday, Tuesday-ish, unless we completely break down. But if we look here at the 5-minute charts, technical indicators, we have quite a lot of positive divergence, which suggests we should see this ABC. into this ideal target zone. I don't think we should look much higher than about 15,400 if this is indeed a second wave kind of disappoints. Though the B wave was 76.4% here on the left-hand side. The second wave was 76.4%. So this second wave could also be 76.4. If that's the target the market wants to reach, so be it. And then we'll see if we get another decline. I don't know yet how this is going to fill itself in. Remember, a second wave can be a flat, a zigzag, or a triangle. No, not a triangle, a flat or a zigzag. And the zigzag can become double. So again, we might be in a little bit more complex scenario, and then we should see 3, 4, and 5. Okay, don't have this 3, 4, and 5 should be like this. Let's see if I can find the chart for you real quick. I didn't have it on here. There. So then we have a 1 here. Okay, bottom exactly where I initially put the label. There, 1. We get the wave 2, 3, 4, and 5. And as you can see here, this 5 of 3 targets exactly the ideal surge. And then 4 and then 5. We didn't really get the CSA target on the NASDAQ 100, which would be 15,600. I think we got 15,222, off by 22 points on 16,000 almost. It's can't get it more accurate. It's off by 0.5%. We have some positive divergence here now on the hourly RSI 5. As you can see, it's a condition, not a trigger, but that would suggest we might see a little bit higher prices first, and then 3, 4, and 5. Same here, 1, 2, 3, 4, and 5. Again, these are the levels we said, watch out for a breakdown. So we gapped out and we broke below 15,337. That would target 15,305. As you can see, your bottom there. And then 15,337 technically becomes resistance because it was support before. And we knew below 15,305, we target 15,256, also reached. And now we might even go to about 1,535 to be determined. But again, we have some positive divergence. So some sort of a bounce, a more pronounced bounce would fit nicely. But again, this could be all. This could be 2, right? This could be it. And this is then 1 of 3. We're now 2 and 3, and boom. That I can't tell you just yet. But I think for now, we're going to look lower. And also here, look at how exactly we nailed the 76.4%. So not we, the market. I didn't do anything. I just forecasted this. And this looks again like a sloppy corrective price action with a very well-defined impulse lower. On the daily time frame, you can see here, this is where we had our wave 2 target box. We topped there exactly, the slightest of overthrows, but closing basis picture perfect. Very pronounced ABC so far. And again, looks like an impulse lower, really been gyrating above and below the 50-day moving average. And I think today we closed also below the 20-day moving average. 3, 4, and 5 to ideally 14,435. The regular NASDAQ, same here, topped exactly in this ideal wave 2 target zone. Yesterday was a nice fakie, right? It's the ideal target zone once, twice, and now we broke below it. Oftentimes, when we bottom in the target zone and we break below it, it's enough. Do it twice, it's really a signal like we're going to go 3, 4, and 5. That still remains my preferred scenario. Also, from a timing perspective, this way forward, it look a little bit better here to the 100% and then to the 200%. That would be picture perfect. Now we get a picture perfect 5-1 relationship. And as you can see, the ideal wave 5 target zone would be exactly at the 100% in red. Dow Jones, again, back in this ideal wave 2 target zone. I think we have potentially completed this ABC, something like this. And we should now be on our way for this wave 3. Okay? /C. And we have an ABC, and then we go rally one more time. This is otherwise a long-term nightmarish mess. This is very difficult. This does not look like a bull market. Anybody who thinks this is what a bull market looks like, I think you need to get glasses, or at least clean your glasses, because this does not look like a bull market. This looks still way better as a bounce. Semiconductors, this is what I shared with you yesterday, that this mess did not look like an impulse at all. Very ugly, overlapping, corrective price action. We might have already topped here for this wave 2 at the 38.2% retrace. It's very possible, it would be very minimal. Alternatively, this was a triangle four wave, 1, 2, 3, and then A, B, C. Could do A, B, C, D, E, whatever you want to. And this is 1. We get the wave 2 bounce, and then 3, 4, and 5. Kind of like this. Looks really triangular. And this was A, this is B, C. Or however you want to count it. Triangles is triangle. Now let's look at market breadth. Okay. Last but not least, we have our breakdown levels again. The bearish scenario is off the table above 45.15 and above 15,522, I believe, on NASDAQ 100. Yesterday's highs are now the cutoff for any bearish scenario. Bullish percent index on the NASDAQ keeps ratcheting down. Only 42% are on a pointer figure buy signal. Not good. Trend is lower. Let's have a look here at the AD line. It is still below this critical level of, I believe, 107,000, somewhere around there. Still not a bull market. This is a bull market. This is not a bull market. All right. This one tracks, of course, the NYSE, which is more closely related to the Dow Jones. But again, not looking happy. Not a bigger picture-wise, not looking happy. We have still to make a new all-time high. The last all-time high was made October last year. So we're branching rapidly going to a year now, and that's the longest since 2009 low without making a new all-time high. How we're doing on the new lows and new highs. New lows are double to triple digits. It's not a good sign. I don't have data for today yet. This is the preliminary data, and as long as we are above 50, it's bears are in charge. Again, the PMO index, I pointed this out on Wednesday. It remains going back and forth. Very sloppy, overlapping price action. Again, not every indicator works all the time. We had similarly here in May. It resolved bullishly. We had similarly here in June, July. This also resolved bullishly. And this then might resolve bearishly. Who knows? But it's confusing. So it doesn't add anything to our analysis other than this also suggests it's corrective price action. Indeed, our preferred edit wave count is correct. Let's have a look at the PMO. The McClellan oscillator, the MO index, not MO. It's negative again. Yesterday positive, negative again. So more stocks are declining than advancing. That means the bears are in charge. Supports our bearish case. How we're doing on the summation index, still no buy signal. Still no buy signal. That also adds to our bearish scenario. Very simple. And then last but not least, please remember that we are in a potential seasonal bearish time. Let's have a look here at the Dow Jones. Actually, I'm going to pull up the S&P 500 since that is still the most tracked. And this is from SeasonX. And again, it should have topped here somewhere around early September, and we're in a decline into late September. If we weed out all the non-pre-election years, we see it similarly decline into late September, though here we should top out not until September 19, but I would say these are always plus minus 3 days, right? So that's a similar type of pattern, pre-election year versus normal election year. We do it for the Dow Jones. We see a similar type of setup. We should be topping early September and decline. It's about the direction, okay, not necessarily the magnitude. So that's really all I have for today. We've been talking long enough. Bottom line is we got most likely a complex WXY correction. We topped at the 76.4% retrace. We did not exceed 55.15 or even 55.20. So we stayed below it. Looks like an impulse lower. Expecting a small bounce soon before we start heading lower. And as long as we remain below yesterday's lows, give it a little bit leeway, 55.15-ish, 55.20, but above yesterday's high, and it's most likely not going to be a third wave lower to 44 or 42.70, I would say. That's where the green sees a. But that remains still our primary expectation, regardless that this wave 2 correction became a little bit longer and more complex than initially anticipated. All right. So remember, we have our contingency plan. We have our primary plan still in place. Nothing has changed. And so far, so good. I think today resolved a lot of issues and still makes me feel good about our prognostication that we will see 42.70 with our contingency plan in place that could still be dealing with a larger ending diagonal. But I really need to see a breakout to confirm that for you. Take care, trade safe, and have a great weekend. And I'll see you all next week.